Jesse,
Yesy.
we have a lot of new followers wanting to know how to start investing or even the right steps to put their money to work. A lot of comments.
Ooh, they want their money to do that thing rich people do where their money makes money. Like where our money grows up and gets a job.
Oh, yes. I love that analogy because you are job hunting. You worked hard for your money. Now it's time to put that money to work through investing. I guess this is
the money. Sorry.
Wait, is this like orientation? Is this college? Is it a job fair?
Ooh, a job fair. That's fun. Yes, let's talk about what first-time self-directed investors need to know to get started so they are not so overwhelmed.
Cue the music.
You're listening to MakeHer, the self-directed investing education podcast that demystifies the world of investing and breaks down complex financial concepts from her perspective. That's us. We're her. No finance bros here.
If you're new here, welcome. If you're a regular, welcome back. We're your hosts. I'm Jessica and Skip. I act as the teacher. I've been working in the self-directed investing space for 15 years and counting. Worked for Scottrade, Fidelity, and Merrill. I was licensed for 10 years and gave up my financial licenses because of the misinformation and lack of information on social media. Currently, you can find me on CNBC, Fox Business, Yahoo Finance, The Schwab Network, and Bloomberg talking markets.
And I'm Jessie Dinwee. I'm a beginner literally learning all of this stuff with you. I convinced Jess to start this podcast with me so I can learn how investing works, knowing it would benefit a lot of folks because most of us aren't taught financial literacy, not in America at least. And learning how to make your money grow helps you not only take care of future you for retirement, but also gives you the freedom to leave situations that might not be so good for you.
Mm-hmm. And together, we're on a mission to make you finfluent and not finfluenced. And we have our honorary podcast guest, Darla, the golden retriever, who's here every time, but really here today if you're on video.
Our mascot. She is
thriving
with her little flower collar today.
She is.
Little princess.
She went to the groomers. She feels pretty. She's showing off.
Oh, yeah. She's glowing.
Yes.
We are all about you understanding how money can work for you. This podcast is teacher-learner style. So Jess will be teaching us all, and I'll be asking the clarifying questions along the way to make sure we stay out of financial jargon land.
We categorize our content in 3 ways for you. So we educate and explain. Honestly, that's every episode. We keep it current and tell you how to apply it on your self-directing investing journey. Like literally we'll show the brokerage firm how to click buttons, things like that. And today we are educating and explaining while sprinkling in a little real life application.
Okay, Jess, what is on the agenda today then?
So I figured since this is the first time self-directed investors, we should focus on the why, the what, and even the how.
Mm-hmm.
So first, the psychology of money. I don't think we've talked about that in too much detail.
We have not.
Good stuff. All right. And then compound interest and dollar cost averaging.
Ooh, yes. Been wanting to talk about that.
And then some terms to know. Figure we could rapid fire because we'll probably have a lot of jargon. And
Yeah.
this is you're new to this podcast, haven't listened to any episode, we'll catch you up real quick type of thing.
Well, that's good. How nice of us.
Yay. And the goal today is to help you think about the blueprint to start constructing your dream home and lay a little bit of the foundation because you're the architect.
Oh, yeah. Architect of your future. Okay, Jess, let's talk about the psychology of money. What are you getting at here?
Very, very, very important, especially now in today's environment. But before we get into that, I have a trivia question for you.
Oh.
The first online retail broker was introduced in 1995. Do you know who it was?
Like E-Trade?
Oh my gosh, you did get that right.
Only because that was my first one when I worked a long time ago, many moons ago at web.com. I got stock for having that job. Like they gave us shares of stock and I had to have something. And I think they just suggested E-Trade for us way back then. So I knew that one was been around for a really long time. That was in 2000 and I don't know, 6 or something, 7.
So they were the first ones to bring it online. There are definitely ones that are older that are online retail traders now. But I love that you knew that. That's really great.
I mean, I didn't know. I just guessed.
You did a great job convincing. But So you're destined to do this, Jesse.
Well, I guess
just
so.
we're destined. Destined. So since they entered the scene, though, markets became even more accessible. Barriers to entry have been coming down since the 90s because technology's progressed. Like it started with you could do an automated phone system, then it went to DOS systems, then it went to an online retailer. Trades, though, they still cost money. They were in the hundreds of dollars, got all the way down to $4.95 until Robinhood entered the scene.
Right. Yeah, because even when I had that E-Trade account, I would get frustrated because if I wanted to sell those shares of stock once they vested in the company I worked for, they charged me a fee. I had to call them on the phone and be like, hey, I want to sell these shares so I can get a house. And I had to pay like a fee to do it each time I did it. So I ended up just selling them all.
Well, that's such a good point, though, because that is a barrier to entry, but it also made you stop and think for a moment because it was going to cost you. So you didn't want to do it. It stopped you from trading frequently.
Right.
Because of the barrier. Now there's no cost, and I don't think there should be a cost. I'm glad. But the point is, people can now place trade with a few buttons, and it used to be a process and a process with a cost. And somewhere we lost the thought aspect of said process.
Oh. This is where the psychology comes in. Like,
oh, yeah, it is.
It makes sense because we spend hours and hours searching for the best restaurant, like the right home to buy, planning vacations. Sometimes I don't think we put that same thought process into choosing our investments. Like, and I know there's a influencing issue and a social media aspect to this, but yeah, like we don't really think about investing in the same way that we do these everyday things that we are very glad to just spend time researching.
Yeah, absolutely. And I think it's because it's easier. And as technology progresses, you still have to qualify for a house and you still have to physically go book hotels and things like that with a vacation. It's more of a process. And when things are less of a process, it's easier. And then that easier is great, but then it also comes with these other consequences. Anyways, we're here to help with that, to come up with that process. The second point is think about times when you invested. If you would have started investing in 2008 or even the early 2000s, so right before the market entered correction territory and then crashed, so before the great financial crisis, before the dot-com bubble, you would have thought it was a mistake because you're in that chapter and you're not remembering the season. You would have thought it was a mistake. You would have freaked out. You would have lost a ton of money. And my parents, they don't believe in the stock market. They're that generation that pulled their money out after the great financial crisis because they saw their 401ks and everything. And it's crazy.
Yeah. If they would have left it in, they would have made it back and then some. We know that now.
Yeah, we do, because you have to zoom out. And I mean, that generation did okay with real estate. They did. But that is a higher risk asset,
Yeah.
But time in the market is more important than timing the market. Exiting those bad situations are detrimental. We cannot time the market, but we can prepare. Just like when you check the weather, you can literally check market forecasts and make sure you have an umbrella or at least the knowledge that there will be a storm.
Right. We say that a lot, timing the market, like time in the market is better than timing the market. When we say that, that basically means like you stay in. And decisions, as we say now, should be calm, collected, and calculated. When we say don't be an emotional investor, that's what we're talking about. The people that get spooked or whatever, they see things are happening and they pull their money out of the market. We say that when you're investing, you're stepping on a roller coaster because there are literal ups and downs. And if you stay invested, no matter what, and you don't pull your money out, time is your best tool for growing your money. You're going to see your money continue to grow. Time.
Yeah, absolutely. We call those ups and downs volatility, has a term. And do you know what makes the market or that roller coaster more volatile?
Uncertainty.
Oh, correct.
As I've learned on this podcast.
Taught you so well, my protege.
Yes, you have.
But I wanted to start with psychology of money today because we have the largest amount of uncertainty in the market right now. Just think about that. Literally, we're up 600 points one day, we're down 600 points the next day. That is huge swings, but it's because that's what volatility is. it means things swing up a lot and it swings down a lot, and it's increased when we don't know what's going to happen. Like with tariffs going in, like there's just so much happening there that we will talk about on our market updates. But we also talked about many episodes ago when we discussed and reviewed Trump presidency 1.0 and talked about the volatility that tariffs brought. The second you heard the word tariff, hopefully you listened to that episode and you're like, ooh, that caused volatility last time. It's going to cause volatility this time.
That's the part of like being prepared that we're talking about. You can't time it, but you can be prepared with, historical data, previous knowledge.
Yeah,
looking at the
forecast.
Yeah, the forecast.
The weatherman. But
it might not always be completely accurate, but you can be prepared just in case.
Yeah.
That's also the importance of an emergency fund, right? Like you are investing for the long haul. Pulling out these funds, your money from these investment accounts, could have a big effect on your overall portfolio. So having an emergency fund, like having that money in your high yield savings account so that you could pull it out whenever you need it, and then put your other money after you have your emergency fund saved, put your extra money into your investing accounts and you leave it there. You don't pull it out when something goes wrong. You leave it because you're going to come back up on the upturn.
Yeah, I couldn't have said it better myself. Beautiful.
Okay, so just some takeaways. When you are investing, you are accepting that there is risk and there will be volatility. Mm-hmm. Time in the market is way more important than timing the market. So don't pull things out when things get hairy and whatever. Just leave it alone. Understanding how it all works helps us make calm, collected, and calculated decisions.
Yes.
Okay.
Yes.
So moving on. And that's like a very basic like money psychology. I'm sure there's a lot more. I've seen like there's so many influencers and content creators out there that talk about it. But that's like some basics, like just so when you say don't be an emotional investor, you know what we're talking about. Mm-hmm. Okay. So moving on, like we said, time in the market has to do with the way compound interest works. We've talked about compound interest a lot. It's basically the interest you earn on top of the interest you've received. But can we go through an example perhaps for everyone? So maybe you could use the presentation you gave to your son's 8th grade class that I saw you post online.
Oh, yes. The story of John and Tess.
Yes.
So funny. There's a little quote around my school where all the 8th graders are, my school, my son's school, where all the 8th graders say, don't be a John, be a Tess. It's my favorite.
Nice.
I love it. It's adorable.
Yeah. And if you're listening, we will post this on YouTube if you would like to watch the presentation. If you're listening on Spotify, we have the video there as well, but we'll make sure you can see it.
I'm so excited to give you this presentation, Jessie. When we're talking about this was designed for 8th graders who were thinking about their career and to make good decisions.
Was this for Career Day?
This was for Career Day.
Very cute.
Thank you.
Of course, you made a presentation.
I sure did. And I didn't tell them what I did until the end. I just wanted to tell them to invest early and often. I literally started it with, okay, how's Career Day? You guys got your first paycheck. Where are you going to spend it? And they're like, Target. I'm like, cool, public company, but we're boycotting them right now. Walmart, public company, McDonald's. Like I was literally just like, I was calling out everything. And so they could understand that the stock market's around them and kind of drilling that in their head to begin with.
Good.
So this is the story of John and Tess. John and Tess have gotten their first jobs. John makes $120,000 a year and Tess makes $70,000 a year. John looks like a John. He's got a blazer on. He's got really nice hair and shoes. Yeah. Tess, I'd hang out with her. She's got on a pink suit with tennis shoes.
Yeah.
She's great. Tess, she says she wants to think about future me. So she's going to save $100 a month for future me. I remember she makes $40,000 less than John. And John's like, cool, I'm going to buy a big house, a really nice car. I'll think about future me later. I will say I stopped here and I asked the kids, and this is a great conversation to have with your kids too, or anyone, or even for yourself. I think it's a good lesson for adults. I say, is $100 a lot of money to you? $100 a month, a lot of money. It was interesting. Some classes said yes, others said no. But keep that in mind. I can't do this voice.
What was that from? Is that what you were doing?
SpongeBob, where his like feel voice. I can't do it. I'd have someone in the class do it. Anyways, 10 years later. So through the power of compound interest, we assumed 10 years of growth. The S&P 500 returns on average annually 10%. Sometimes it's up 30%, sometimes it's down 20%, sometimes there's a lot there. So we say on average 10%. It's a conservative number. Realistically, it's going to move around a lot more.
Mm-hmm.
She deposited over that period $100 first, then her total deposits were $12,100. That adds up. However, through compound interest, she saved $20,245 because her money made money. Investing.
So compound interest, it's the way interest earns interest. Like if you put in that $100 a month and you're getting 10% interest at the end of the year, that $100 turns into $110. Now you're getting 10% interest on $110 instead of just $100. So that's how it compounds. The amount you put in is the same, but you have interest added on top of to that amount. So now that amount keeps getting interest. And then ideally, you also keep adding in more each time. So that's how compound interest works. You're getting money on top of the money.
You visually said it really well. It's really good.
Thanks.
You're welcome. So John, look at John. John's got a Lamborghini and a huge house.
Because he makes so much money and he wants to be flashy and he wants to buy all the things.
He does.
And show how much money he makes.
Now, this is the part where I asked the class, what do you think John's bank accounts look like? And they're like, we don't care. That's awesome. And, I gave this presentation last year and everyone kept asking me what car I drive and things like that. And that's why I added this in the beginning of it. It used to be very different.
Interesting.
So I wanted to show those decisions because they were assessing how well someone was doing based on outward appearance. And I wanted to tell them that wealth is quiet. That the most powerful person in the room is the person that can do whatever they want, not the loudest.
That's right.
So, boom. Tess is excited. She said, I saved over $20,000. She's decided that she's going to save more now, $250 a month for future her. Now, mind you, this is 10 years later. This is designed for 8th graders. But in a real situation, hopefully you got a raise. You're also going to have a 401k. You're going to have other things that are contribute to this. And $250 a month is going to be great, but hopefully you could do more. And you would be able to do more because you shouldn't have the same salary over 10 years. John says, nice. I'm going to start saving $275 a month. He's going to do more so he can catch up.
But he's missed 10 years of time.
He has
at
missed
this
10
point.
years.
Okay.
He has, yes. But
so he's contributing more, but he's getting a 10-year late start contributing more. But he thinks he's going to make up for it by adding or, contributing more money.
Exactly. But let's see what happens. 20 years later, Tess has $315,000. Again, I asked the class, do you think $250 is a lot of money? At this point, they kind of get what's happening and said no. And then the second I showed the screen where over 20 years with a $250 monthly deposit compounding 10% annually gets you $315,000. And she's literally only deposited a little over $70,000. Kids immediately say, I'm doing this today.
Now they understand.
Yeah.
Yeah.
Which is great. And then I love to say, well, how do we think John did? I made him have an angry face. He still did great. It's still the power of compound interest. He saved almost $200,000.
Yeah.
The moral of the story is 10 years and $12,100 ended up costing John $100,000.
Yeah. So if he would have just started, maybe had a little bit less of a flashy car, so he had a little bit lower of a car payment each month, he could have put that extra $150 into an investing account.
Absolutely. He
investing
could have.
in the S&P 500. And yeah.
Now, he might have done okay with his real estate. That's very possible. It's a big house.
True.
But maybe it was in the southern belt that got hit by a hurricane. You don't know.
Yeah.
Risk asset.
Especially now where insurance is getting harder and all that stuff. You never know what's going to happen.
Yeah. But the point is, a lot of times we get this question often, oh, I feel like I need $500 or can I start now? Now it doesn't cost anything to place a trade. So the barriers to entry have been brought down. So consistent buying early and often, even if it's $10 a month, is going to make a big impact.
So the takeaways here are a little goes a very long way. You do not need to have hundreds or thousands of dollars to start investing. You literally can start with $20, and that will add up over time. $12,100 ended up costing John $100,000 in this example, which is like mind-blowing to think about. I know this has to do with dollar cost averaging and a bunch of terms, and I think we should go through those jargon terms and define them.
Yeah, and this will feed into the how and what they are investing in. We described actually passive investing, which is when you mirror or copy an index fund. Most people, for example, use the S&P 500, which is that sentence already full of jargon.
Yeah, let's maybe rapid fire explain the basics. Every term is in the name, as we always say. And we do have an episode full of all the terminology. I think it's like somewhere in the 30s, 32, something like that. But yeah, let's just start. We'll start with a stock. A stock is just a tiny piece of a company. And if the company becomes more valuable or less valuable, your stock will be more or less valuable.
The stock market is a place where you buy and sell those stocks. All the stock exchanges are connected through it. So get it? Stock market is a place like a marketplace. You buy and sell. What do you buy and sell? Stocks. And then the stock exchange, it's where you you list those stocks and they exchange the stocks on that. I know that one, we can go very deep on that, but that's the high level.
Very high level. And you measure the stock market, like its performance, through an index, or you might hear the word indice, which is just a collection of stocks. It's an elite club. There is criteria to be in that club. And if you do not meet the criteria, you are kicked out. And this literally happens quarterly with the S&P 500.
Yes, it does. Over time. Self-cleaning machine it is. The S&P 500 is a very common index where the constituents or stocks in the list are the largest 500 companies in the US. So you invest in that, you're investing in a bunch of companies. A bunch of companies are the 500 companies in the US.
And I just said this on my story today, just to connect those dots. If you're worried about being invested in the S&P 500 because some of these big companies we're trying to ban right now or whatever we're doing as consumers, they could go out of the S&P 500. You're always going to have the top 500 companies. So if you're invested in an index fund that mirrors the S&P 500, you're just always invested in the top 500 US companies, no matter who they are, what goes in and out. So, just to alleviate that fear. You cannot buy that index directly. It's a measurement. So the S&P 500 is a measurement of how those 500 companies are performing. But you can buy an ETF, which is an exchange-traded fund. Remember, exchange, stock exchange, which is what Tess and John were consistently dollar cost averaging into in the presentation example.
That's right. And all dollar cost averaging means is that you are buying at different prices every week, months, whatever frequency you decide. So your cost is smoothed out literally like an average. It just means you're constantly or consistently buying. So you could buy at $100, you buy at $105, you buy at $110, you buy at $90. Dollar cost averaging means you just take all those, divide it by how many I said, literally the average. That's it.
Yeah, that term actually was very confusing to me for a long time. So basically it just means that you are consistently putting money into your investment account, no matter what's happening in the market, whether it's up or it's down. You're putting the same amount of money or a consistent amount of money each month or each paycheck, no matter what, forever. I mean, long term.
That's right.
And that's why it's dollar. So, and I think it's abbreviated DCA. People, if you see DCA, that's dollar cost averaging. The alternative to that is maybe only putting money in when things are low, or so people call it buying the dips. And that's when we get into timing the market, which is what we say, you really can't time the market. I mean, when things are on a downturn, you could invest more if you wanted to, but you want to at least stay consistent at the minimum amount you're able to consistently give each week, month, whatever you're doing. Keep it that way. That's what dollar cost averaging is.
Absolutely.
So the takeaway here is you're going to hear a lot of these terms, a lot of jargon. You don't need to memorize them all, but the terms make the stock market seem so overwhelming. That's what was so overwhelming to me when I tried to start a long time ago. And I missed out on the 10 years. I'm kind of like John, but it was because I just was very overwhelmed and confused and no one was explaining it to me. And I thought that I had to be rich to invest. And that's just not the case. You can start with $5 now. Things have changed. So it doesn't have to be overwhelming.
Mm-hmm. So true. Love it.
Okay, well, we have a lot of episodes that go incredibly deep on each of these topics. And we've created playlists for you in the show notes if you feel like binging Market Maker. And of course, feel free to share the playlist for this episode. We also have some playlists on our YouTube channel. Literally as much information as you could ever want on these topics. Way more than I thought I was going to be learning when I started this podcast with Jess. I've learned way more than I thought I was ever going to learn about investing in the stock market and the economy and the Fed and all the things.
How do you feel about that?
I feel great. Like I feel so smart and informed, and I didn't realize it until I would start talking to people, or someone would ask me a question or they'd say something and I would answer it in a way where I didn't even like recognize myself because I am not a finance person. You know, I'm a marketer by trade. So yeah, I feel I feel very empowered.
I love that.
All this knowledge. Yeah.
It's amazing. You made tingly, Felix. Oh, I love that. And next week, we're going to expand on this and we'll talk about how to choose a brokerage firm. I'm actually very excited for this episode. I started a new job in July, and part of that job is talking to all the brokerage firms and deciding who has the best tools and features. They would literally show it to me. And it took 6 months to come up with that data. So we're going to share it with you.
Ooh, I want an additional brokerage firm. Like you can have as many as you want, as long as you're not going over the annual limits on your IRAs and things like that among between all of them. But yeah, you can open accounts at all of them. You have, right?
Yeah, I've too many. I'm really excited to do my taxes.
There is that factor. But yeah, the features and benefits and tools, we go over them in previous episodes, some of them at least. So yeah, excited for that one.
Me too. We show up for you. The best way you can show up for us is by leaving us a review or sharing this podcast. We just want to spread the financial literacy. Tell us how you really feel, good or bad. We'll take it. We thrive on criticism.
And until next time, remember, when you build knowledge, you break barriers.
You break barriers. Remember, investing involves risk. There is always potential to lose money when investing in securities. Market Maker provides educational content and resources for informational purposes only. We are not registered financial advisors and do not provide personalized investment advice. Any information provided by Market Maker on our website or podcast is not intended to be a substitute for professional financial advice. Market Maker is not liable for any investment decisions made based on our content.